Okay, we agreed that this was the sign, right? When I pick up my hand, that's it. I'm not going back and editing anything else out.
We're good.
Let's go.
And
not that we've started and stopped 2 or 3 times already. This is it.
We totally haven't.
Raw, unedited. It's what the people want.
Yeah.
They want to see reality. All right, so we're going to talk about reality.
Yep.
We're going to talk about tax law changes. Current, imminent.
On the
edge, and what might be coming. Including some things that we have been expecting, and they may or may not pass, and some things that we've talked about in prior videos that
have disappeared.
Right. At least for now. Okay. All right. So you're going to talk first about the infrastructure bill that, at least as of this recording, has not yet been signed, but is going to be signed by the president. It's been passed by both houses. So it's all but law. Again, by the time folks watch this, it may have been signed.
Right.
And there is a lot in that bill that we're not going to talk about here, but a couple of things specific to tax matters. Right? The word tax sets you off every time. I don't know why, but
I know.
All right. What are they? 2 things.
There are a lot of things in this bill, but only a couple of things that we want to mention in this video that are related to tax.
I'm going to take a sip of my coffee and hope it doesn't get picked up by the microphones while you're talking about this. Go ahead.
So the first thing is the employee retention credit. That's something that we've made videos about previously. It will now be cut off after the 3rd quarter of this year.
Right.
It was set to go throughout the remainder of the year, and I think to help pay for some other things in the bill, they have decided to make the 3rd quarter the last quarter.
Right. And I don't know what kind of projections they've got on how much that's going to save them. That's not really the point of what we're talking about, but I mean, it's got to be significant because the credit was, as we've talked about in prior videos, for 21 was up to, and correct me if I'm wrong, up to $7,000 per employee per quarter.
That's right.
Up to, not necessarily 7, but up to 7,000.
Right.
So I mean, that's got to be a lot in terms of their estimate for how they're scoring this.
Right.
But it's a big deal. It's a big deal for taxpayers, for our clients, and for other folks out there who maybe weren't counting on it, but they were hoping who've already applied or maybe in the process of applying, we're hoping that they were going to have that for the 4th quarter as well.
Right. It was a really great credit for those taxpayers that did qualify.
Right.
But so 3rd quarter is the last quarter for qualifying wages.
Right. So, and this is something you mentioned earlier when I said, okay, well, it's gone now. You said, well, you can still apply. So if you have not already applied for the employee retention credit, if you think you may qualify, and there are, you do have to clear certain hurdles to qualifying, and we've talked about that in prior videos. You can still do that. It's not that it's gone for all quarters. It's after the 3rd quarter. It wages after the 3rd quarter of 2021 are not eligible.
Right.
But up through the 3rd quarter, they are. So if you haven't applied, you still can.
Right. And you apply on amended returns.
Right.
So that can still be done for the qualifying quarters.
Right. Okay. There's something else that was mentioned that I know is something you've been very interested in for a while. It has to do with cryptocurrency, or really maybe digital assets, probably how it's termed in the law.
Yes. I think Mike gets a little annoyed when I start talking about
I get annoyed. It just
digital assets.
It just makes me feel like an old man.
But there are some provisions in this bill related to reporting of transactions for brokers.
Yeah.
Now, that is a definition that we have yet to see.
Right.
Who qualifies as a broker?
Yep.
So more to come on that.
Right.
But there is a provision that will require brokers to report transactional information.
And we will discuss the term digital asset and cryptocurrency again when we talk about Build Back Better, which we're going to do in a minute. But this, what you're talking about, is in the infrastructure bill, which again is, as you said, it's teetering on the edge of being being actually signed into law by the president. It's already gotten through Congress.
Right.
Okay. And again, by the time anybody watches this video, it may actually have been signed. So let's switch from that. Let's talk about, if you like, let's talk about the Build Back Better bill, plan, whatever, that at the time of recording, I know the House has this for debate and discussion. I think the speaker has talked about trying to get this passed by the week of the 15th of November. We are not a political team. This is not a news show, but everybody knows the current climate in Washington. Lots of other things that are going on that might make passage of this bill doubtful, suspect, who knows. The provisions in this act, in this plan, have changed several times. We were talking about this back in the summer when the Green Book plan came out that had a lot of stuff in it that some of that stuff is here, but a lot of it's not.
Yeah.
So, and I've got my very detailed notes here, and you have your even more detailed notes there. We cannot talk about everything that's in it. There's no way. And the stuff we're going to mention, we can't talk about in detail.
Right. Let's just hit the high points.
Right. So what's the first high point?
What is not in the version as it exists today?
Right. Things that we have discussed in other videos and other posts.
I'm going to quickly hit 4 things. Ready?
I'm ready.
The increased top ordinary tax bracket.
Okay, yeah, that was planned to possibly go back up to 39.6%.
Right.
But is not in Build Back Better. So the top individual rate still be 37%.
Right.
Okay.
Increased long-term capital gain brackets.
So it would remain at 20% because it's not being touched in this. There had been a proposal that it could go up to 25%. There was that proposal at one point. So that's gone. Right now.
The reduced state tax lifetime exemption.
This is huge, right?
This is really big. There were a lot of people that were really eyeing this and, doing a lot of planning around the possibility that it may go back down to about half what it is right now.
Right.
They actually released the 2022 exemption today.
Right.
It's $12.06 million per person.
So that's graded for inflation. It bumps up a little each year.
Right. So it's still very high.
Right.
And the other thing somewhat related to that is the proposed changes to the step-up in basis. Yeah. Those are not in this version of the bill. Right.
And those two things had a lot of people really worried. I know we've worked with a number of people in planning in potential anticipation of that. So it is important for folks to know that's not in this current bill, but it's probably also important for folks to know that doesn't mean it's not coming back up.
Right.
It's just not in this bill. And you've heard a lot of folks who are on the side of passing this bill talk about how this is just a step. So those provisions, that wish list, that larger wish list isn't necessarily gone. I can guarantee you it's not gone. Again, we're not going to get into politics, but as much as I might like to. But yeah, those things were big, and they're not in this particular bill that's being discussed right now.
Right, and not in this version. Like we mentioned already, we've seen several updates to it just since it's been being discussed in Congress. So, what will be in the final version, we'll make sure we keep you posted. But this is the version as it is right now.
Right. So was that 4 things?
Yes.
Okay. So that was the 4 things that aren't in it.
There were some other things, but those are probably the top 4.
Right. And again, some or all of those things we have discussed previously in talking about things to keep an eye out for as this process continues. And here we are getting toward the end of the year. So let's talk about some of the things that are in it. Or actually, let me pause real quick and mention something. You and I did not talk about this beforehand. It's not really a curveball because you know this. We discussed quite a bit. Again, we did at least one video on it, talking about how some of these changes, again, some of them are now no longer in this bill, they could potentially be retroactive.
Right.
What I'm seeing, tell me if I missed it, is that most of the stuff that we are talking about, and we're going to mention some highlights, aren't going to be effective until 2022.
You are right about that. There is one provision that I saw that would be effective as of the date of proposal, which would be September 14th, 2021.
And what is that one?
That is the exclusion on qualified small business stock.
And that is one that you did want to mention.
Yes.
Yeah, the topic of qualified small business stock could be an entire seminar in and of itself, and has been. But it is a tax favored status for qualifying stock, but there are, I think, income levels at which those savings get bumped down.
Right.
And what's currently in the bill is to basically take that ceiling or those stair steps down a bit.
Right.
Right.
And we keep hearing, you've heard it, we've heard it, the magic $400,000 number. And this provision just so happens that exclusion would be reduced for high earners,
Right.
which is being defined as those earning more than $400,000.
Right. Yeah.
So-
So again, qualified small business stock. We won't go into that in detail here, but just know that somewhat scaling back those benefits for those high earning taxpayers
Right.
is on the table.
Right.
So that is the one provision that at least the one that we're going to talk about that if passed in its current form is retroactive to September.
Right.
Okay.
That's right.
But it looks like most of these others effective in 2022, again, if passed, which again is not what was originally advertised for a number of these provisions. So what else?
Right.
One thing I did want to mention, because this is something a number of our clients take advantage of, and a lot of folks do know about this, the R&D Tax Credit, or really technically known as the Research and Experimentation Tax Credit. It's a perennially temporary benefit that is in the law. It keeps getting extended. It would be extended in this bill. I would guess it's probably a near guarantee that whether this bill passes or not, they will extend the R&D tax credit. So I did want to mention that. It's not all bad in terms of potential tax increases.
Right.
All right, so what else?
Well, there
Bless you.
are some other things that will be extended with this. The child tax credit will
Right.
be extended through 2022.
Yep.
I know that's been a big topic this year as they were sort of prepaying it throughout the year.
Right.
And that's the plan that will continue through 2022.
Yep.
So that's another good thing. The proposal right now, this is another thing that you and I didn't talk about beforehand.
What's up?
The cap on salt.
Yeah, this is a big deal.
This will be a big deal for a lot of people.
Because there's been a lot of news around this, but it's the whole red state, blue state, because the blue states tend to be those with higher state income taxes. You've got some states like Texas and Florida have no income taxes. They capped the deduction for state and local taxes, not just income, but other stuff, at $10,000 for the Tax Cuts and Jobs Act.
Right.
That again, that has been a source of a lot of consternation ever since that happened.
Right.
This would raise that.
And this, a lot of people, I would say it applies to most people, are limited on that deduction.
Right.
So this would increase it to $80,000.
Yeah.
Which would be great.
That's a big deal.
That's a big deal.
A lot of people, I know a lot of folks with whom we work would still be limited, but that right there is an additional $70,000 deduction.
That's right, and that would apply to the 2021 tax year.
Okay, so that one also would be 21. Okay, good deal. Good deal. So it's some of the givebacks are potentially effective in 21. Again, that's just the act as we see it right now. All of this is subject to change.
Yes.
What else? We probably are running up against our time. What else you got?
I will quickly mention,
Yeah.
just because we already said we would,
Yeah.
the crypto provision in this.
You just want to talk about crypto again.
I do. It has to do with watch sales. So in typical investment accounts, watch sales are disallowed. We won't go into that in detail, but for cryptocurrency, digital assets, there has been no wash sale rules. So this puts into place those wash sale disallowances for crypto.
Right. Okay. Yeah, I'm glad you mentioned that. We did say we would mention that. Real quick, we don't have time to go into detail, but while the income tax brackets, or at least the top rate, would not be going up with this plan,
Right.
they really are. They're just not calling it that. They're sneaking it in and calling it a surcharge at very high levels for individuals.
For individuals.
Right?
Yes.
So talk about that for a second.
Okay, so there are a couple of different levels. There is a 5% surcharge for individuals that have an excess of modified adjusted gross income
Right.
of $10 million. Yeah.
Yep.
Want to make sure I said that right.
No, I think you got it.
And then the
It's
next,
going to change, so whatever.
Yeah. And then the next level is an additional 3% on modified adjusted gross income over $25 million.
Right.
And that is for folks filing jointly,
Right.
$25 million.
Yeah. So again, while top individual income tax rate is still 37%, well, not if you hit those income levels.
Right. So, most individuals that have adjusted gross income over those levels,
Yeah.
we'll be looking at this a lot.
Yeah.
If you don't have modified adjusted gross income levels with those amounts, it's nothing to worry about.
Right.
But I will say this.
Yeah.
Trust and estates.
I'm glad you bring this up because this does not make any sense to me.
Right. This is a huge difference between individuals and trust and estates for this provision.
Yeah.
Trust and estates hit that 5% surcharge limit at earnings of $200,000. And then the extra 3% surcharge once income reaches $500,000.
And that's significantly lower.
Which is significant. And there will be a lot of planning around
Right.
distributions from the trust to individuals, really looking at tax rates and where income should be taxed. So it's really huge for beneficiaries of trust, for people who use trust for estate planning purposes.
Right.
And I think even about the Secure Act that limits retirement plans to that 10-year period.
Right.
And we had a lot of folks that were using trust to prolong that period for inherited IRAs and things like that. So, it's something, again, to take a step back and really look at your overall plan because that's huge, an additional 8% on top of the ordinary rates that you already hit the top ordinary rate once you have over about $13,000 of income.
Yeah.
So you hit it very quickly.
Right.
So trust and estates are, as it is written now, you're going to take a big hit there.
Right. Yeah, it's going to be interesting to see how that works out. Now, there's one more thing, and we're probably going long on time, so if you've hung with us this long, thank you. There's one more thing that I wanted to mention, and I think it's a big. A lot of these things are big deals, but this I think is a huge deal, and that is the potential expansion of what's currently the net investment income tax to not just be a net investment income tax. I'd call it net income tax. There is currently a 3.8% net investment income tax that applies to investment income. Without going into a lot of detail, the current proposal would basically expand that to apply to active income on pass-throughs at certain income levels. It's like $400,000 because that's like the magic floor, right? We're not going to raise taxes on anybody under $400,000. $500,000 married filing jointly. Again, who knows what it'll end up being.
Right.
But the thing is, this is a big deal for people who run small businesses and run them in pass-throughs. Now, it does look like pass-through earnings that are going to be subject to self-employment taxes likely won't get hit by this. So there's some discussion here of partnerships versus S-corps. You and I talked about this before. We're not going to go into that in detail. But what this, there had been some discussion, the pass-through deduction. the Section 199 Cap A deduction, there had been some talk of scaling that back. That's something else that is not in this particular bill. All this does is potentially take some of those dollars from savings on that pass-through deduction and gives it back in the over-application of the net investment income tax to active pass-through income.
Right.
So this I think is a big deal, or I know it's a big deal to people who run small businesses and pass-throughs. If your income is over 400,000 or $500,000 married filing jointly, or however it ends up.
Right.
Right. I get that right? You think?
Yeah. So it really seems that all income will either be taxed with SE income tax or this new net investment, non-investment income tax.
Yeah, it does. I mean, that's getting into a lot of complications, and we're going to have to see what we get, if anything.
Right.
But that's going to be really interesting. And if there is a part of this that I don't like, I mean, there are a few things that I'd prefer on behalf of our clients and other folks in business that we not see happen, but that is the one that frankly bugs me the most. I don't know that I should be an advocate for or against here, but I am.
Yeah. Well, and again, that's for high income taxpayers. Only, which they are defining as those. At those income levels.
Right. So once we stop the cameras and we look at how much time we spent talking about this, we're probably going to say, this video is way too long. We don't need to post this, but we're going to do it anyway. So if you've hung with us and watched this whole thing, thank you.
Yeah.
If you haven't, and you come back and check the end later, well, we understand. Thank you for that. We're going to post this it's on our YouTube channel, social media. You can go back and see any of our prior videos on other stuff if you want to see the evolution of some of this stuff to now. As always, you need to talk to your tax and business advisors about your situation. You need to be keeping an eye on what's going on in Washington, what we end up getting out the other end of this process. We're going to keep watching it and talking about it on behalf of our clients and the public at large.
Yes.
You got anything else we need to?
Everybody's situation is different, so planning for everyone is different. And we will post another video once all of this becomes final.
We will.
So that we can keep everyone up to date.
Yep. And again, we've been gone for a while in videos, but we hope to be back to a regular schedule either now or sometime soon. So I guess that's it, right?
Yeah.
So now we're going to just pose nicely and speak like it's like everything is great and professional, and we'll stop the camera and edit where we need to. So everybody have a great day.
Thank you.